You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and I'm joined with a member of my multifamily investing team, Mr. Jeremy Goodrich, who is the owner and commercial real estate advisor at Shine Insurance. Jeremy has been on the team with hundreds of investors, including myself and Team Quattro, helping us manage risk and get clarity around our insurance strategy. Jeremy, friend, welcome to the show. How are you doing?
I'm doing so good, Chad. It's so exciting to be on the show with you. I love what Quattro's doing. I really appreciate your team, and everybody has such a great role. And so I'm just excited to talk about how the team works, how insurance works, and just get to chat with you for a little bit.
I'm really excited about it. And as the director of acquisitions at Quattro Capital, you and I tend to interface a lot because we're always sizing up new insurance policies. And I've learned that that is an art and a discipline, and you have to have an expert on your team or you will fail. So that being said.
Yeah, I think for new investors, I mean, you really do have to engage with an insurance, and this is true for all service providers, but an insurance advisor that really is there for you. And at the beginning, even I work with lots of folks who don't have any properties at all, and they're just like, hey, what's a ballpark on this thing? And that's a legitimate question to ask the person that you find in that insurance role on your team and expect them to have a decent answer for.
Absolutely. Well, Jeremy, we can talk all day on insurance, and we're going to, but before we do that, tell us who Jeremy Goodrich is. Tell us about Shine Insurance. Like, how did you get to where you are in the insurance world? And just help us get to know you a little bit real quick.
Well, it won't surprise you to know that I didn't grow up wanting to be an insurance agent. I grew up and I was a teacher for 13 years. I was an elementary school teacher. I taught third and fourth grade. So I taught kids how to love reading, how to love math, how to love writing, how to love hockey, which was one of my favorite things to teach, and all sorts of things in between. So for 13 years of my adult life, I've been a teacher. During that time, I met my wife and business partner, Mackenzie. She's a third generation insurance agent. And long story short, the agency that she was working at, she was like, you know what? I'm not into like the culture here. It's just really not who I am. I was ready for a change from being a teacher. And we said, hey, what would happen if we took your sort of teacher style of doing things and my knowledge of insurance and started our own agency? And so we started Shine Insurance in 2013 with the goal of changing the way people feel about insurance, of just really being honest, being straightforward, educating enough, but not oversharing, and just trying to make smart insurance simple. So that's what I've been doing for the last 8 years. And it started in the home and auto world. And then I grew into single family rentals, insuring those. And now all I do is commercial real estate. It's my specialty, and I do it all over the country.
That is the best tagline. Let me go back and look at it here. Make smart insurance simple. Wow. That statement covers a lot right there. So with that being said, yeah. Let's just start diving into the world of insurance. Maybe we'll just start with, what are some common pitfalls that people fall into? Most of our listeners are passive investors in syndications. They're in my deals, they're in other people's deals. Some of them are actually doing their own deals. Let's get a crash course in what it means to be smart with insurance.
Love it. I think as a passive investor, obviously you're not digging into the weeds of an insurance policy in the same way that an operator is, right? And so what you really want to know is that you trust your operators to make great decisions about the people on their team. Everything when it comes to insurance it starts with the insurance agent that you pick, the risk manager. When I look at myself, I don't see myself as an insurance agent. I see myself as a risk manager. I'm looking at, okay, what is this property? What does that mean? How can I make sure that we protect it as best we can? So for passive investors, we all know that when we're deciding on a deal, the operator is the number one most important thing that we're thinking about. It's more important than the market. It's more important than the asset. You have to believe in the operator and the business plan that they have. And I think if you believe in your operator, then you believe in them to pick a really good insurance advisor. And that may be as far as you truly need to go on the insurance side, although I'll tell you some stories about why you want to make sure that that's the case. But really, trusting your operator is a big key. but making sure that that operator is hiring an insurance advisor that's considering the entire risk as opposed to just the cheapest price.
It makes a lot of sense. And I'm sure there are a couple of stories that go with finding the cheapest price, but I'd love to just start with some of your stories and have story time as we go down internalizing some insurance lessons. So where should we start with that, Jeremy?
So yeah, I think that the lessons are in the claims, right? I think that my job on the front end, when people are asking me what's the cheapest price and how can I get it super cheap, I have to think about, okay, well, what does this policy do in a claim scenario? So let me give you a couple examples. I have a client right now who owns a lot of properties, but one particular property has a commercial downstairs. It's a tattoo parlor and a couple of apartments upstairs. Parlor was open on a Friday night. Suddenly, out of nowhere, where U-Haul truck comes through the window into tattoo parlor. No one's hurt. I don't generally tell stories that involve injuries, so I'll just say that right from the beginning. But no one's hurt, but there's a U-Haul truck in the middle of the tattoo parlor inside of this commercial property, right?
Wow.
So at that point, the client is giving me a call, and suddenly insurance means a whole lot. And so, that person's coverage was awesome. In fact, in the end, even though it wasn't their fault, right? A U-Haul truck came through. Really, it should be U-Haul's responsibility, but the U-Haul insurance policy was hard to find. The person's auto policy was very limited. So our policy paid out the way it was supposed to, walked them through the process of fixing their building, fixing that window, paying for the lost income associated with that tattoo shop having to be out of the building for a while, and addressed the situation all together, finished it up. And then the insurance company turned around and went after those other people, which our client didn't even have to navigate. So I think that's the power of a quality insurance company who's walking you through stuff and helping you take care of a situation.
That's a fantastic story. And I think you kind of breezed over a couple of key items in a policy that one needs to look at. So I can't say enough. Yes, price is important, and you should always strive to get the best policy for the lowest amount of money, right? But that does not mean go to unadmitted carriers. It does not mean, sacrifice coverage for cost, because that's when it will cost you dearly if something happens. And I know there are certain aspects of that policy or those policies that are less likely and some that are more likely, right?
Yeah.
So before we go to the next story time, what are a couple of just like a couple of key disciplines within a policy that one should be looking at to make sure that a property is accurately covered?
So I think there's really four basic things you need to think about. And one of them really doesn't apply that much to our apartments anyway. But I'll say them out real quickly, right? So the first thing is coverage for the building itself. If something bad happens to your building, if there's a fire like I'm dealing with right now with a client who had a fire there's fire in one building and then smoke damage in another building that's right next to that one. They want to know that their insurance policy is going to replace the damaged building. That's the most common thing we think of with insurance. And obviously that's important. We want to make sure we have coverage for that. And the rule of thumb there is make sure you have enough coverage to rebuild that property. I was just talking on another podcast with developers who were saying to build condos in downtown Boston, it's around $200 to $300 a square foot to rebuild a condo right now. And I'm thinking, wow, I'm insuring buildings. I'm pushing investors to insure up to $150 a square foot, saying, look, it's going to cost that much to rebuild this if we have to. And that might even be low, where I'm seeing policies all the time that are insuring for $70 a square foot, $60 a square foot. That's not going to build half of a building. So the first one is building coverage. The second one isn't as big of a deal in apartments. It's called business personal property. This is the stuff inside. So if you pick up one of your apartment buildings, turn it upside down and shake it, what falls out? All that stuff is called business personal property. Don't do that, Chad. But in general, if you could, the things that fell out would be business personal property. Well, most of that stuff is owned by your tenants. It's not yours. And that's why tenants have renters insurance policies. Well, there's multiple reasons, but one is that if a fire happens, those tenants will naturally think your insurance is going to cover their stuff, and it's just not true. So if you know they have a renter's policy, you'll know that their stuff is going to be handled. And so it's not going to be a real tough situation. I had another client recently, had a fire in the house. All the tenants came to him and said, all of our stuff is gone. Are you going to help us replace it? And, he was like, no, that's not my policy's responsibility. Do you have a renter's policy? And they didn't. So that didn't take care of it. Business personal property is number 2, but it's not really a super big deal for apartment building owners because there's just not much of it that you have. If you've got an office, then you have some. Otherwise, you probably don't. The third one is called loss of income. And so if a building burns down and it's down for a whole year, let's say there's 8 units in there. Well, you lost all that income, right? So that could be $100,000 of lost income over the course of a year while we're rebuilding that building. As long as it was a covered loss, your insurance policy is going to include your lost income in that payout. So not only are they going to pay for the building to be rebuilt, but they're going to cover your lost income, which obviously is super key when you have investors, and for a passive investor to know there's not going to be a capital call because there's a fire, because the insurance policy pulled through and took care of you like you wanted to. And then the fourth one is the most important insurance coverage of them all, and that is liability insurance. So this is coverage for if bad things happen to other people because of you or your buildings, more often your buildings in these kinds of scenario. So that could be anything from a claim I'm dealing with right now. A woman slipped and fell. It was she was a tenant. It was in the middle of the winter. She slipped and fell, broke her wrist. She went to the hospital, cost a couple $1,000s, but a personal injury attorney stopped in her hospital room and said, I bet I can get you 20. So now we're dealing with that. Well, that investor is not dealing with that. And that, in fact, I think the investor sent me an email a week ago and said, hey, have you heard anything on this claim? We haven't talked for 3 or 4 months about it. I went and looked. It's pretty much all finished up. I told that investor what was going on. That's all they had to deal with in that situation, right? It's just the insurance company takes it and deals with it. That's a tiny little situation of maybe $10,000. Obviously, in one of those fire situations, if unfortunately someone were to pass away or something like that, now you're really talking about big numbers and big money, and that's why liability coverage is so important. So that's the 4 coverages that you have to care about. There's tons of stuff in the weeds, but those are the 4 main things.
And I'd love the next story time to be on the general liability section because and the funny thing is, this is honestly one of the cheaper parts of a policy.
It is.
Right? And people skimp on it all the time. I don't understand, because you think you don't need it. I mean, attorneys will come up with anything to get paid. And believe it or not, some states, I'm thinking Georgia particularly, with some of the case precedent I've seen lately, they're siding with the resident on some of these bogus and absurd claims of how in the world. For example, and you may have told me this story, actually, I'm not sure, but when I was trying to insure an Atlanta property not too long ago, there was, the rates were pretty high for a moderate crime ridden area. It was not really, it was just inner city, right? It was not that bad of an area, but there had been case precedent recently in Georgia where sadly someone had driven by and performed a drive-by shooting, and a bullet went through a wall of a building built in the 1960s, through another wall, and hit someone. I don't believe that person passed away, so I wouldn't be telling that story if they did, but they sued, right? They sued the landlord because his walls couldn't stop a bullet.
Yeah.
Tell me the last time you tested bulletproofness on a building you bought.
Add that to your DD list there,
and
Chad.
They won, Jeremy. They won. So anyway, I mean, I'd love to hear some of the stories that you've had from the general liability space.
Yeah.
I wasn't sure you had many.
Yeah. And I think, Florida is another example of a state where you're seeing states really side with the other side from insurance companies. In fact, in Florida, personal injury attorneys, I don't know the exact details of how it works, but they get paid like triple what they would in other states if they win. So their capacity to make money off of litigation against insurance companies is higher in that particular state. And so there's all sorts of the idiosyncrasies of that. But I think the bottom line that all the stories around liability coverage, the emphasis is you don't have to deal with it. So in a claim recently, this was about a year ago, where there was that fire and someone did pass away. Obviously as a property owner, you can't imagine the feeling of someone dying in your property. And in this case, it wasn't their fault. It wasn't like they hadn't wired the property, they hadn't upgraded the wiring or anything like that. It was the tenant who had started the fire, and then it just went really wrong. In this case, I'd say the liability scenario was there wasn't anyone trying to take advantage of anyone. Someone passed away in a situation. They were, family was trying to get compensated there. But, in those scenarios, the litigation, all the back and forth between lawyers, the ultimate payout and feeling that it was actually taken care of, the actual doing right of a family that has experienced something like that, all taken care of outside of that property owner's own personal experience. Did they have to engage with it in that scenario? Absolutely. There's engagement going on there. But did they have to pay for it or worry about the out-of-pocket expense? No, because they had the right amount of liability coverage. And I think that's a key point. You can't skim on liability coverage, because a situation like that, you just don't know what number it's going to land on.
So true. So true. And so we've talked about the big four, items of an insurance policy. If you care to repeat them real quick.
Yeah. The building coverage, the main building, business, personal property. If you pick up the building, turn it upside down, whatever falls out, loss of income, the money you would have made from the building if it were performing, and finally, liability coverage for bad things that happen to other people because of your property.
Sorry, I just didn't want to take the risk of failing the pop quiz on live on the air. So,
but there you go. You've heard it twice. So the pop quiz.
I've heard it twice. But again, I've hired Jeremy to be my expert, so I don't have to look at that. Yeah. But point being, in addition, there are also other, we'll call it not minutia, but other important subcategories in a policy that I know we've had to pick on in the recent past. Things like, ordinance and law. And I'm trying to think of another one. We've actually had to worry about flood protection and the mitigation thereof, which some cases, like if someone tells you your property's in a flood zone, that's not always a black and white definitive final answer. Sometimes that can be fixed. But what are some of the other, we'll call them auxiliary coverages, that one should be aware of? I mean, and think from the passive investor's view, when they're sitting there, questioning a sponsor and whether they want to invest in a property or not. They've ascertained they like the person. They've ascertained, okay, the big four are good. What are some of the auxiliaries that maybe they should be looking for that might be special case on a given property?
That's a great question. And there are a ton of auxiliaries, and auxiliaries not only as additional coverages like flood or earthquake coverage or ordinance and law, which is weird and I'd love to describe, but also exclusions, things that aren't covered or are covered at a lower amount. And so things like ACV coverage, which is a lesser coverage where they subtract the depreciation of the age of the building from the claim payout. So if you have hail damage to a roof and it's going to cost $10,000 to replace that building's roof, but the roof is 20 years old, they're going to say, well, the roof is 20 years old, so we're going to depreciate, and the payout is now going to be $4,000. You'll have to come up with the additional $6,000. So if you see ACV on a policy, that's just another way, excuse me, that you're going to feel burned in a claim situation where you're literally going to have depreciated value on something that you have to replace at true replacement value. You can't go out and buy a 20-year-old roof and put it on the top of your building. That just doesn't make sense. But if a policy is set up that way, you're going to be depreciated because of that. So I would say looking both at additional coverages, but also sort of secret hidden things. And just to quickly say some of those, ACV is one. The co-insurance clause, the hated co-insurance penalty. If you underinsure a building, so lots of people want to underinsure a building because they want cheap insurance and they don't care if it actually performs or not. So why can't I, if I want to insure, if I've got $1 million property and I want to insure it for only $500,000 because I don't think it's going to burn down. I doubt the entire building is ever going to go down, which is fair. Okay, I can hear that, right? So I'm just going to insure for $500,000. I'll hope I don't have a total loss. Most things will be smaller than $500,000. Well, you have a claim. It's only a $40,000 claim. You say, I've got $500,000 coverage. It doesn't matter. But you have that co-insurance clause in the policy that you get penalized for how much you underinsure. So you insured for 50% of what you should have, And so in that $40,000 claim, because of the co-insurance clause, you're only going to get 50% of what the actual situation was. So even in a small claim, a $40,000 claim, in that example, you lost $20,000 because you underinsured. So co-insurance clause is another way that you can get burned in a claim situation. Insurance companies and people who buy insurance policies have gone back and forth for hundreds of years, one side trying to figure out how to get a cheaper policy and still get the right coverage, and the other side saying, wait a minute, that's problematic. We've got to fix the policy so that doesn't happen anymore. And so many of these things are because of that back and forth. So ACV coverage, co-insurance clause, you mentioned flood. That's a huge one. There's a lot of investors who won't invest in properties that are in flood zones. And, I think that's absolutely fair. And I understand it because I think there's a lot more risk there. I don't love investing in properties in flood zones. I want to know that the people who are investing really know what they're doing, absolutely have flood insurance and have that protected. So I think that's a big decision maker for passive investors. Earthquake is another example. There are some weird ones like mine subsidence. The town of Evansville, just south of where I'm at, has some abandoned mines in it. So when you're buying a property in that town, you do want to make sure that your buildings are not above those abandoned mines, because if those abandoned mines were to collapse, your building suddenly structure has changed. There's no coverage for that unless you have mine subsidence coverage. So great example there of just different coverages that a smart insurance agent is going to be looking at and thinking about, even if you aren't.
So that you brought a couple of questions. I'm going to switch from host and play student for a second because I have two questions for you now.
Yeah.
First of them is on the building replacement cost and the co-insurance discussion.
Yeah.
So and if this is true, I'm curious if it's ever safe to do that, because is the insurance company going to look at building cost at the time you originated the policy, or are they going to look at it live as of the date of the claim? And the reason I ask that is, let's say you didn't quite skimp, but you maybe went at 95 or 100% of today's building replacement cost, right? Well, let's say 5 years from now you have a claim, and 5 years from now building costs has doubled, and I have that co-insurance clause. Do I now get hit with the difference between the two numbers?
Yes. So there is some balance. There's a couple of idiosyncrasies. Like all insurance, nothing is concrete. So there's idiosyncrasies. But so if you have a 100% co-insurance clause, which is something I try to never do, that means at the time of loss, they're going to assess the 100% replacement value of that building and figure everything based off of that. If you do, some insurance policies will waive the co-insurance clause altogether. That's great. It's not always possible, but that's awesome. What is more common is having an 80% co-insurance clause. So what that's saying is we don't get penalized as long as we're insured at least 80% of the replacement cost. And so that gives us some space for change and things of that nature. So I like to have either a waived co-insurance clause. Obviously, that's the best. Although with companies that waive co-insurance, they're always wanting to have super high numbers. So there's a balance happening there. 80% co-insurance is generally fine as long as you're insuring to what you feel it would actually cost to rebuild the building.
I've never truly understood the co-insurance and how it's set up until we just had that conversation right there. So that's very good.
All of your passive investors are like, great, now I understand co-insurance. If I ever become an active investor, I get it.
Yes. Sorry, guys. Had to do that.
No, very I love good. It though. Those are just little things. If you're a passive investor, it feels a little bit weird, and I'm not sure I've ever done it as a passive investor, but if you say, hey, I'd like to see the insurance policy, some of the things in these conversations, if you're seeing the term ACV, if you're seeing 100% co-insurance, if you're seeing building numbers that are way lower than say $100 or $125 a square foot, then you can rest assured that this insurance policy is not going to take care of your property in the way that it should. Now, whether you want to ask to see the insurance policy is really up to you as a passive investor. But those, right. Everything we're talking about here is clear red flags around whether a policy is actually going to take care of you.
Yeah, that's fantastic. And guys, your sponsors should not be afraid to show you their insurance policy deck page. That is not a secret. They have to give it to a lot of other people along the way when you're closing a deal, including the lender. It really should be public knowledge if asked. It's not something that they're going to willingly show typically, because there's details people just don't usually want to see, right? But you should be presented with it if asked. And also recognize that it's not, in some cases it's black and white, but there's not like a, yes, this is a good policy, or no, this is a bad policy. There's certain red flags that he just said that's like, yeah, you probably don't want that. But there's the threshold from good to, or from like good risk mitigation to total risk mitigation, right? And all of those are good. So your sponsor may have different risk thresholds depending on the property, the location. Like, for example, I'm not worried, and I don't invest in Florida because of this. I'm not worried about wind and hurricane damage in Tennessee, right? Well, I'll take that back. In Ohio, for example, right? We have tornadoes in Tennessee, so I had to walk back on that. But I'm not worried about hurricanes and typically in that area of the country. So I'm probably not going to go get hurricane coverage. But that's an extreme example, just something to think about.
Yeah. And you're really right about the market, because I'll give another example. I'm dealing with a Hurricane Ida claim right now in Louisiana, right on the coast, a property that was picked up as a heavy lift, high vacancy, very old building. And over the course of the first year, the plan was and still is to renovate and lift this thing up. To get an insurance policy for a 60% vacant, mostly some totally empty buildings, apartment complex right on the coast of Louisiana at all is a tough thing to do. So the coverage in that policy is not as good as one that I can get in Indianapolis, Indiana, or Cincinnati, Ohio. There's simply some things you have to sacrifice when it comes to coverage, especially if you're in a high risk area.
That makes sense. And another final nugget, then we'll get to the closing remarks here, but we're doing a project in Augusta, Georgia, for example, that is like that. It is a very heavy lift, multiple vacant buildings. It's going to be great, right? But we actually were asked to carry a builder's risk policy in addition to that, because that's borderline a construction project. So, different levels of those value add projects might come with some other requirements to fill that gap, I think.
Yeah, insurance on heavy lift apartments is a skill. It's sort of like being a batter that comes up fourth in a professional team. The Red Sox I watched last night. I don't know who the cleanup batter is, but anyway, you really have to have a skill to be able to find the right companies, find the right price, and still get quality coverage on a 150 or 200 unit apartment complex that's a real heavy lift.
Fantastic. Well, Jeremy, this has been a fantastic educational episode, even for me, who's been originating policies for a while with you and others. Yeah, I learn something every time I talk with you. So I really appreciate you coming on the show. Before we let you get off the show, though, you have to answer a couple of questions in what we call the Quattro Trio, 3 questions we like to ask every guest on the show. So, Jeremy, what is your superpower as it relates to this industry?
I think it's explaining, and the capacity to explain things simply. I love this industry. I love the people in it. That's what it really attracted me, is every single person I met in meetups or whatever had like a different backstory, had grown up with some different passion, and somehow it ended up in real estate. And so I really love this industry, and I love being able to simplify just one small part of the process and be on the team to be able to do that. So I think and hopefully I've succeeded at that in this conversation, but the capacity to explain things as simply as possible, I think, is my superpower.
Making smart insurance simple. I love it.
Yeah.
Have you heard about the Multifamily Investor Nation Summit coming up on January 20th? If you've never been, it's a 3-day information-packed event for multifamily investors with over 1,000 attendees and over 50 speakers. Not only will you hear from experts about finding deals, raising capital, underwriting strategies, selecting markets, and so much more, but this year, our partners here at Quattro Capital are excited to be participating with 3 speakers at the event. Our amazing Kim Wendland will be speaking on the often neglected subject of asset management, how to make the machine hum. While our most interesting man in real estate, Maurice Philogene, will be speaking on how to leave your corporate job for a freedom lifestyle. I personally will even be speaking on the topic of how to perform due diligence on multifamily assets before you purchase them, and the not so common things to watch out for. Go to mfinsummit.com to grab your ticket and use promo code Quattro to get $100 off of your full access pass. Whether you are new to multifamily investing or a seasoned investor, you do not want to miss this event. Join Team Quattro at the Multifamily Investor Nation Summit. Visit mfinsummit.com, promo code Quattro. That's mfinsummit.com, promo code Quattro. All right. Well, tell me some dirt, Jeremy. What is your biggest failure to date, and what did it teach you?
I love it. So every insurance policy that gets written with Shine Insurance, a percentage of that premium goes to our program called the Giving Back Program. And we have three community groups. We've focused on homelessness specifically as the topic that we're trying to address. And so two groups in Bloomington, Indiana, in the town that I live in. One is called Beacon, which is they have a bunch of things they do around homelessness, but they have shelters and community dinners and just a whole lot of things going on there. And then the other is a space, a shelter for families in particular. It's called New Hope. And this
actually
is a shelter
love and
for
respect
families.
Do that. And I think in our first
They're actually
conversation,
building
you
right
said,
now.
if this is what you're looking for, I'm not your guy.
Of
Right.
Course,
And
completely.
we were looking for someone to help us accurately and, most cost effectively, but accurately protect
so those two
our assets,
organizations
not just give us
are the
that rate
two
insurance. And you actually
we have.
pointed
And then
out
we
some
have
holes in our
we love
existing policies that
animals, so
we've
we
since
stretched a
rectified.
little bit
So
this
we
year.
appreciate
The
that.
Monroe County
Absolutely.
Humane
Yeah.
Association also receives a fair
Well,
amount
one
of
of
money
the
from our
4
clients
Quattro pillars
each
is
policy. So those
philanthropy.
are the
Tell
three.
us
You might have
about
asked
a
for one,
philanthropic
but
cause
the
that you
one
are involved
overarching
in
thing is
and
our
what our
Giving Back
listeners can
program,
promote on
and
your
those are the
behalf.
three organizations that receive that. So at shineinsurance.com, you can find, how to connect with us. And in the commercial real estate section, we have a complete guide to commercial real estate. So a lot of the conversation we've had here dug into a little bit deeper and an overview. All of our clients get what's called a portfolio overview, which is just a really clear overview that usually is accompanied by a video where I explain what's going on with this particular asset, this particular portfolio. So I give you that overview as well that you can use for yourself no matter where you get your insurance.
I love it. I love it. All three are great. And folks, as usual, those organizations will be in the show notes. So feel free to scroll down if you're driving and you can find a way to support on behalf of Jeremy Goodrich and Shine Insurance. All right, Jeremy. And it looks like you actually have a free gift here that will help explain the big 4 pillars of insurance that you were speaking of. What is that and where can we find it?
Absolutely. Shineinsurance.com is the main place to connect with us.
Fantastic.
If you'd
And
like
those
to
are
listen
great,
to
by the
our
way, for those of you
podcast,
who
it's
are originating or
REIClarity.com,
acquiring
all
properties
about
and
real
getting
estate
loans on them.
investing. And our
Whenever I get a
YouTube channel is
policy
doing
back
all
from
right. We've got
Jeremy, I
about
get a
14,000
Loom
subscribers.
video with
Things
him
all
screen
about
sharing on
real
the
estate
comparison
investing and
and
certainly
showing me
commercial real estate
exactly what's
insurance.
what, why he made what decisions, where we might be, deficient because of the property, the area, and what things to look for. So it's just a fantastic way to where I don't have to be the expert in insurance. I can trust my expert to convey the main ideas to me. So that is a unique bit for Shine Insurance that I will just testify on there. Yes, exactly. I remember dark days of making my own comparison spreadsheets, trying to compare different policies, and it was I don't want to go back to those days.
Absolutely.
So fantastic. Well, folks, this has been an amazing episode, educational episode. I really hope that you have taken as much from this as I have. Jeremy, I think you alluded to this already, but where's the best place for our listeners to get in touch with you, whether it be just to say hello, to support a philanthropy, or to learn about commercial insurance and originated policy? Fantastic. All right, Real Estate Runway family, this has been another episode of the Real Estate Runway podcast. For now, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.